I think India is pretty well placed if you ask me, because India's exposure to US goods exports is insignificant. It is 2% of our GDP. And it is well known that our tariffs on relative to our key competitors like China, Vietnam are lower. So if at all we are at marginally at an advantage. As a result of this, what is happening, the oil prices, the US 10-year yields and dollar have fallen sharply. And each of which are positive for India. I don't think, I mean, we care a lot more about oil than the impact on 2% of our GDP. And as far as the markets are concerned, while short term is always uncertain, I think there were two large sources of supply in this market which have sharply moderated. One was the primary market. We are all aware that investors have lost considerable money on capital raising in last 6 months. So I think the appetite for has gone down dramatically. So you can see the primary market activity has come off maybe 70, 80, 90%. And I don't see that reviving in a hurry. So that source of supply of new stock is gone. I think FI selling has moderated considerably. It will moderate even further. The US markets are now underperforming other global markets after a very long time. So therefore, I feel that fund managers would look to rebalance their portfolios. And let us ignore what happened yesterday. That was a big development. But over next few weeks, I would expect even foreign flows outflows should moderate sharply. Who knows? They may even become buyers. I think everyone knows that India is the world's one of the fastest growing economies. Our fundamentals have not been impacted. Our relative competitive position is improved. The fall in oil prices is clearly going to benefit us. And above all, I think the valuations have turned a lot more reasonable. India's Nifty is now trading close to 17 times calendar 26 earnings, which is reasonable even for a 10 to 12% earnings growth, which I feel is a realistic estimate. See, one thing which has changed sharply over last 1 or 2 years is the gap between India and US yields has collapsed. If you go back few years, this gap used to be 4 to 6%. Now it is running between 2 to 2.5%. So I think that lowering of cost of capital is a big advantage, and equities over time, I think, will price that in. I think 12 odd percent is a reasonable return for Nifty over 2 3 year period on a compounding basis.